Know your worth, learn to value your business in 30 minutes. My name is Joel Comerford. I'm part of the Lawpath team and I am your webinar host today. So first and foremost, let's address the elephant in the room. We did have some technical issues yesterday. Unfortunately, we did have to postpone until today. So anyone who was affected by that, we sincerely apologize. And we're so delighted to have you here today. Usually on a Friday at 12 o'clock, depending on if you're on the Eastern side, it's usually drinks with workmates. So we do apologize if you've had to put that off for now. So if you've ever wondered what's my business actually worth, or how do buyers or investors even figure that out, you're in exactly the right place today. We're going to simplify business valuation today. So there's no jargon, just clear, practical takeaways you can apply straight after this session. And for those of you who are new, Lawpath is Australia's leading online legal and accounting platform for small businesses. We help over 600,000 businesses across Australia creating legal documents, manage compliance, and connect you with lawyers and accountants all in one place at a click of a button. Our goal is simple: to make professional legal and tax help accessible, affordable, and actually easy to use. So whether you're starting a business, hiring staff, or managing contracts, or like today, learning how to value your company, Lawpath gives you the tools and advice to do it confidently and cost effectively. So let's start with why this matters. Most business owners don't actually know what their company is worth, and that uncertainty can hold you back from making smart moves like raising capital, taking on investors, or even planning an exit. So knowing your worth helps you make informed decisions for growth, funding, or sale, avoid undervaluing your hard work, and identify opportunities to increase your business's value over time. So I just want to pose a quick question for everyone to get the brains ticking. How many of you here thought about selling or bringing on an investor? Or maybe you've just wondered, if I sold my business today, what number would I actually get? You can go ahead and drop a yes or curious in the chat so we know who we're talking to today. I'm loving it, guys, loving it. Excellent. So almost most of you. Fascinating. Perfect. Well, you're in the right place then. We're joined today by Timothy Quinn, Head of Tax and Accounting at Lawpath Tax Advisory. For those of you who don't know Tim, he is a chartered accountant with 18 years of experience helping small and medium businesses with valuation, structuring, and tax strategies. He's worked at the director level, leading tax divisions, and he specializes in helping owners understand not just what their business is worth, but how to increase that value strategically. So Tim, it's great to have you back as always. Now, what exactly is Tim going to be covering today? What business valuation really means and why every owner should know it, the three main valuation methods and how to choose the right one, key drivers that increase your business's value beyond just revenue, the common mistakes that cause businesses to be undervalued, a simple framework to estimate your value, plus how to prepare your business so it's valuation ready at any time. And we'll also wrap up for those newbies a Q&A at the end of today's webinar. So if you do have any questions, please go ahead and chuck it in the Q&A throughout. We will address those. Yeah, just please, guys, don't be afraid to pipe up. Like this is a safe space. You can say whatever it is that's on your mind in relation to your business. Obviously, if you have a question that's accounting or tax related that might not necessarily be associated with today's webinar, go ahead and chuck it in there anyways. We might be able to see if we can offer a bit of guidance for you there. I am going to go ahead and throw it over to Tim now. We will have today's episode recorded and uploaded to our YouTube link. I will also send an email out afterwards with that YouTube link, the slides, as well as some partner offers. If you are moving into a new accounting phase and you're looking to hop on Xero or MyOb, we have some wonderful discounts in relation to that, as well as some more information on how our legal, accounting, and tax plans can benefit you moving forward. Tim, go ahead and take it away.
Thank you very much, Joel. Wonderful introduction as ever, and thank you everyone for joining us, particularly those that tried and struggled yesterday. It's great to have you back. Good little crowd in today, and as Joel I think alluded to, so many people are here for a very good reason. They've got that curiosity. They're looking to the next steps. They're wondering, how much is my business worth? Why is this such a common thought for small business owners? Often you're not paying yourself a great wage. You might be in the building phase. You might be making the sacrifices now to build something with real value down the line. And until you really know what that value is, it can feel like pushing something uphill. So I think we're going to keep today reasonably light on the theory, and we're going to push the practice of it. I absolutely love valuing businesses. My team does too. We really look forward to the opportunity to do it. Um, but I think it's something that accountants gatekeep a little bit. We make it seem more complicated than it is. And to be fair, there are times where it is incredibly complicated. But to give yourself a ballpark idea, I think most small business owners can do that themselves. So keep your powder dry, keep your money in your pocket until you really need a formal valuation. In the meantime, let me teach you how we can help you do it yourself. So we'll jump straight in. What is a business valuation? Well, a valuation exercise is an art and not a science. And then forgive me if I keep coming back to that mantra. There is only one occasion, one set of circumstances where a valuation is exactly on the money correct. And if anyone wants to drop that in the chat while I talk, the one specific instance where a valuation is always correct, I'll award you 50 internet points if you get it right. Otherwise, we're always dealing with ranges. We're always dealing with between something and depending on other things. And I've had two answers that are correct on the chat already from Deepak and Scott and James, actually. Good on you, James. So the one-time evaluation exercise is completely accurate is once you've completed the transaction, assuming that the buyer and seller have equal access to open information, which is a big carve out. But in that scenario, that's when your valuation is crystallized. If you're willing to sell it for that much and someone's willing to buy it for that much it's worth. But of course, that's a long way down the path for a lot of people. What we're going to try and do with these approaches to valuation is give you an estimate, give you a range of what that endpoint might be. So whatever method we choose, and we will go through a few of them, it's going to be dependent on your financial performance. It's going to be dependent on what your business has got and what it owes. And more importantly, what its potential is. Knowing that now can help you structure your business and make decisions to increase that value down the line. So we're going to look very practically at how we can do that. If anyone thinks they're going to go out to a business broker and sell their business tomorrow, I have very bad news for you. Selling a business actually takes longer than you'd think. Even getting things ready, appointing brokers, appointing legal, appointing accountants, that takes a while. And there is only the beginning of the process. So what you'll see is that for the vast majority of business sales, you'll do what's called a data room or due diligence, and you'll open up your books. And suddenly everyone starts to have a peek around. So let's get your books ready. For a start, why do you need to do these valuations? Like I said, it's almost never completely accurate. It's never I dare say a valuation exercise I've done has never picked the eventual final price exactly. But there are a few reasons we do it in advance of that. Certainly buying and selling business, of course, you do that to understand your position and to lead your negotiations. Not necessarily just buying and selling, but a few valuation exercises that I'm doing at the moment is when you're looking to bring on investors. And you might think, well, why would you need to do a valuation exercise for that? Particularly if they're friendly negotiations. If you've got, a long-standing staff member that wants to buy into your business, but actually doing a formal valuation exercise can distance the issue, can make it a little bit less personal. It's, hey, let's look at something more objective here. Let's not risk a relationship by thinking that someone's been hard done by. Let's come to a scientific point. Valuations can be done for financing and funding, less commonly. Tracking your performance, sure. And this golden nugget, this succession planning or planning for an exit, I think that's always in the back of everyone's mind. I don't think many businesses start up today thinking, I'm going to be doing this for the rest of my life. But even those that do, they often think, well, I might give the business to the kids down the line. And if you're like me and you feel like you've got 100 siblings that would always be squabbling over stuff, maybe you want to do a valuation to decide how you might split that business. So let's talk about these main methods. And there's sub methods within these. Leave the theory to the accountants. Let them get tied up in knots. Just let's talk about the big ticket ones. A market-based valuation approach is trying to estimate that final position just based on looking at similar transactions. So looking at transactions that are going on today and trying to find a similar business and find a similar price for that reason. The reason that nice little graphic down the bottom is cafes is that it's a very common one. If you're on Parramatta Road or wherever you might be, Queen Street Mall, and if you know that a cafe with a certain square footage is worth a certain amount, there's a pretty good chance that a similar sized cafe is going to fetch a similar price. So it's quite a useful metric. It seems very basic, and of course you might pick that as a starting point. And you might say, well, my cafe's been refurbed more recently, so it's worth a bit more, or I've got serious draining issues, so maybe mine's worth a bit less. But it's a really useful starting off point, and it's something that is very visible. You see a lot of these, particularly through brokers. You do see what they're selling for. There is available transaction data. So it's very useful for those established industries where there are what we say a very liquid market, where there's lots of buying and selling and going on. So it's useful, but it's probably only a starting point. I certainly wouldn't be signing off on anything from my side on a market-based valuation method like that. The income-based ones, these are the ones that we're really going to focus on today. So if you get in the back of your mind that this is probably going to be the one most relevant to you as a small business owner or as a potential small business investor, let's keep this one back of mind. This says that your business is worth what your future profits are worth today. Now, these can be backwards looking or forwards looking. The gold standard is the forward looking one. It's looking at projections of your future income. And we almost never use it for very small, well, for reasonably small businesses in Australia. Anyone have a think about why we don't really use projection-based valuation methods? And I'll explain the backwards-looking ones while we see if anyone wants some more internet points. So the backwards-looking projections say, well, let's work out an estimate of what business profits you'll generate in the future by looking at the last 3 years. Makes sense, right? It makes sense that if your business is doing a solid $500,000 a year profit, you're probably going to maintain that profit level into the future. So it's a reasonable estimate, and that's what's called the maintainable earnings. So if you basically expect that, well, your business has consistently made this level of profit, we can probably expect that someone will be willing to buy those annual profits at a multiplier of those profits. And we'll jump into what that multiplier might be a little bit later. Deepak's come in, he's gone 2 for 2 with correct answers. It is very, very hard to do projections, which is why we don't use the discounted cash flow method so often when we're talking about small businesses. It is very difficult to predict small business growth. It's very difficult for both sides of a transaction to agree on that, put it that way. It's typically the seller is very generous with their projections, and perhaps the buyer is less ambitious. So that's correct, James. There are always assumptions being made. And again, it's an art, not a science, but it's more of a science looking backwards. We've got historical data to back you up. Look, this method is more commonly used for the service-based recurring revenue businesses, but I will say it actually applies to most small businesses in Australia. The asset-based valuation methods are really at the bigger end of town, which is, if the CFO of BHP is on this webinar, I haven't seen his name pop up, but if he is, he can talk to me about these methods in more detail. This is basically, what are your assets? Let's subtract your liabilities. What's left over is the worth of your business. Now, you might think, well, my balance sheet doesn't show a lot. It just shows the value of my plant and equipment, my cars. I wouldn't sell my business just for that. We would also value intangible assets. So the idea of the value of your brand, your goodwill, your intellectual property, we would put that, even though it's typically off balance sheet. When we do an asset-based valuation methods, there are ways of valuing that intellectual property. Interestingly, typically those methods do dip into income generating methods. So it's a bit of a mixed bag, this approach. You will also use an asset-based valuation method sometimes for pre-revenue, early growth, early stage companies, because the income-based methods rely on there being profits. If you're building software, very typically, if you're building IP, um, often the simplest way to value it is how much have I spent on it, and how much, maybe if we've got some early signs that it's going to be valuable, that might push the value up. Don't worry too much about choosing the right valuation method. I'd say leave that to me. Let me give you a hand on that one. Just know that for most of you, it'll be the income-based approach, and for most of you, it'll be looking backwards. So for the rest of this webinar, whatever you want to call it, conference, give it your own name. For most of the rest of this chat, we are going to be looking at a backwards-looking income-based method to value your business. Right, how are we going to get here? We're not going to, when we do this method, we don't do it once and put it in a bottom drawer. When we look at valuing a business, in the back of your mind should be, what are the levers that we can push to move that value up? Now, you might be thinking, I've talked about this multiplier before. You can quickly see that a small change to 1 year's profits can actually mean a big increase to your value or decrease, because you're multiplying that year. So it's really, really important to look at your business now and understand those key drivers. It isn't about revenue. Look, some businesses do get valued on a revenue multiple. Funnily enough, accounting firms are a very clear example of transactions that do generally happen on a revenue multiple. But most of the time, we're talking about profits. And we're not talking about one-off profits. We're not talking about, I had a stonking last year because I had a huge government contract that was grossly inflated and I made a fortune. That's not really a valuable business moving forward. We're talking about a sustainable business with a good breadth of customers that we're keeping. We're not having to rebuy customers every year. So when people talk about churn and things like that, are we keeping and reservicing those customers? How's our brand? You could just look at the books alone and think that a particular business might be very valuable. Let's pick some of the big childcare for-profits. Some of them, if you just looked at their financials, look fantastic, but you consider the wider picture. Maybe there's been a bit of scandal in the news and in parliamentary inquiries and things like that. So what do we look for as an investor? When I represent buyers, and I represent both buyers and sellers, we look at consistency, we look at predictable cash, and we really look to, what does next year look like? Are things on the right path? If you just improve these few drivers, and it seems simple, it's the basic running of your business, it'll really increase your value. And like I said, the time to completion for these transactions is long, so don't feel like it's too late. Start now. You might not be in a position to start selling this business for 12 months. Fantastic. Let's pull those levers now. So when we talk about the main driver is obviously financial performance. It makes perfect sense. We love to see revenue growth. We love to see something that has a good future. Scalability is very important. If you can show that your market reach is expanding, that's very, very healthy. Good for your valuation. Obviously, profit margins, important, which is not to say it's the end of the world. Your profit margin might take a dip in a particular year because you might have said, well, I'm actually going to cut back my profit expectations. I'm going to invest in the business. I'm going to increase headcount. I'm going to hire some more people, even though I don't need them today, but I'm going to need them tomorrow. I'm going to need them next year. So you might think, well, how does that show up in evaluation? When we come into the details of these income-based approaches in particular, I'll show you how that financial performance isn't the end of the story. It's just the beginning. Clear financial records. Now, I do apologize for anyone that comes to hear me every couple of weeks. This is, funnily enough, something that comes up in every single webinar we do. We always talk about the need for clear financial records. It is a common thing. If you go in to value a business that hasn't lodged any tax returns, that hasn't prepared its BASs, that's, you do a quick review, you can tell that the taxable income hasn't been calculated correctly. Your confidence in those numbers comes right down. And when I do due diligence reports for potential buyers and potential investors, it is the first and most obvious red flag. And often early in the process, I might pull the potential buyer aside and say, we got a problem here. Do you actually want me to continue with this report? Do you want me to continue building this valuation? Because I don't trust their numbers. So having consistent approach to compliance is really going to build that level of trust. And it's going to let the numbers speak for themselves, and it's going to build a better story. Again, we keep saying consistency of performance is key, not just one-off spikes. Now, the second one, the customer base and retention, it makes it obvious. If you're looking to sell a business, you want as a buyer coming into the business an expectation that you're going to keep customers. You're going to build on those strong relationships that the previous owners have made because you're going to use them to make profits. Everyone knows that it is cheaper to keep a customer than to buy a new one, this cost of acquisition. So we love it if we can keep strong relationships and keep good customers. So if you've got a loyal support base, it's going to help your valuation. And any information you can keep on that is valuable. So we've touched on this already. It relates to other things. Your brand name, your reputation. It doesn't mean do you have a nice logo, although that helps. Is it a defensible brand? Is it unique in the market? Does it have a bit of recognition? Do people know what you're talking about when they talk about your business? It's difficult to really put a fine number on, but you know when you see it and you know when you don't. Your systems and processes. So invariably, when you look at these business acquisitions, there might be a plan for the old owner to stay on for a little while and sort of help on it in a handover period. That's quite common. But eventually, you're buying a business with an expectation that you'll be running it and the previous owners will be out the door. Now, you want to make sure that all of your processes have been documented, that they're systematized, that they're automated if possible, that to whatever extent someone else can pick up hopefully a slim folder or a slim digital file and learn how to run that business themselves. If it relies on a lot of internal IP or a lot of internal specialist knowledge, it's going to be more difficult to sell. It's going to rely on a lower valuation. And just to pause quickly, we have had some questions coming through on the chat. Just a reminder, I promise we'll get to them by the end of this as well. We'll just keep on going for now. So we touched on this already, but both your legal and your tax compliance is very important. Making sure that everything is lodged, everything is registered for. You've got employment contracts, particularly for key staff. Everything like this is documented and accurate. I'll always encourage anyone to meet with a lawyer for a quick legal review of their business when they're looking at selling in the future. So not the day before, because I can tell you that the buyer will be looking for it on their side. And don't leave yourself the surprise. Don't put the power in the buyer's court to say, haha, we got you on these legal compliance issues. Get them sorted early. Now, on that, here are some things that I've seen in my own experience that have led to a lower than expected valuation. Now, it's very much the flip side of those drivers that we just talked about. So it's again, those outdated financial records. I've encouraged people to walk away from transactions and I've suppressed valuations based on the fact that I don't have trust in their records. Likewise, the over-reliance on the owner. Often you might think that a business that you're looking to buy has really great brand reputation and that it's really powerful and it's got a strong customer base. Ask yourself, does that IP, does that value of that brand attach to the business or does it attach to the owners? If the owner was to walk away and set up a different company under a different name, would all those customers leave? You can put anything you like into a legal agreement, a non-compete clause. There'll always be people that'll look to get around it. And so, and at that point, if you're having to sue over a non-compete, things are going wrong. So are you too reliant on yourself? And if so, maybe it's time to start getting yourself out of the business more gradually before an exit. Have you thought about, again, that IP? Some of this know-how, even up to the point of trademarks and registered IP is actually sitting in the wrong entity and it doesn't attach to the business. That documentation, not up to scratch, you're not reporting regularly, all of these things will suppress your valuation. And that's just a very basic example. Just those ideas that if you get yourself caught up, your valuation can increase. It says 25%. I think that's a very conservative valuation. I've seen valuations go up as much as 100% based on fixing those things that are non-financial. All right, how are we going to get this business ready? You've decided, you've thought off the back of this webinar, I'm ready to sell my business. How do we get things ready? Get organized. Get organized early. If you're not happy with your accountant or your lawyer, change them now. Give them time to get their feet under the desk and get your stuff up to date. Start to document, start to review, get your key people in order. If you want to use a business broker, go for your life. They're expensive, but there's a reason people use them because they do get good results. But start this process early. Don't look until the last moment. So get yourself cleaned up, documented, all of those things. Now, I've tried to rush through those last couple of slides. Here's where we get really practical. Here's how I'm going to show you how to value your business. And there's a big precondition on this. This will only work if your records are up to date. So the tax compliance freak inside of me is excited because you're all scrabbling now to reconcile your Xero files, as you should anyway. But here's where it's going to be useful for you. This is a very simple framework. Your business value, and this is using that income looking backwards approach, is your annual profit multiplied by an industry multiplier. Now, those industry multipliers are different for different industries, but I'm about to give you a pretty core one that is going to apply to a lot of small businesses. Now, that is really straightforward, right? It's a little bit more complex in practice. When we talk about annual profit, we really mean normalized EBITDA. So what that means is you strip out certain things. You strip out interest, tax, depreciation, amortization. We strip out those. We add them back. We say, well, they're not relevant, and we normalize. The normalization is something that a lot of people skip in this step, and it means what it says on the tin. To normalize your books, it means what would this profit and loss statement, what would this annual profit look like to someone else buying the business into the future? I'll give you a key reason why that makes a huge change to businesses. And it's something I said right at the start. A lot of small businesses don't pay themselves a wage. You might be in this business 60, 80 hours a week, and you're not paying yourself a cent. You might be paying yourself dividends at the end, or you might just be in that stage of grinding and building your business and wanting to keep every last cent in that business. In that scenario, that is not a fair reflection of your business's profit and loss. If you've turned out $100,000 profit, but you haven't paid yourself a cent and you're in a specialized industry where your salary would normally be more than $100,000, the first thing I would do, acting on behalf of a buyer, I'd say, well, I need to normalize that profit and loss, and I actually need to put in a pretend expense for $100,000 to say that's how much it would cost me to hire someone to do your job. At that point, that business that looked quite valuable has suddenly gone to nothing. So you need to bear this in mind, that if you're thinking of selling, know what the other party is going to be doing. And I'm telling you, if the other party's hiring me, the first thing I do when I look to normalize is I look to see those wages. In some occasions, people are overpaying themselves. Fantastic. Then the normalization works the other way. Your business is actually more valuable. But I would say in most scenarios, you'd look and see that really we're not capturing the full value of wages. That is not to say that's illegal. There is no tax concern with underpaying yourself as a business owner. It's just to say that when I look to value a business, I will bear that in mind. There are other things we do with normalization. Like I mentioned before, if you've had one big bulky contract that's not going to be renewing, I might factor that in. COVID was a very interesting time for business valuers because we had to really struggle and think, well, how is COVID affecting this business? And it was different for everyone. Some business valuations went up during COVID, some went down. And you saw a lot of that activity even at the high end M&A, mergers and acquisition level. Your Uber Eats and your menu logs suddenly felt a lot more valuable during COVID. And obviously your retail shops went down significantly. So they're the sort of things we think about. Let's pick a really simple business here, though. We've said it's got a normalized profit of $120,000. We know from the industry that the multiplier is 3. How do we know that? Because there's lots of available private data that says that businesses in this industry around that size do sell for a multiple of 3. This is an observable value. You can go out there and find these multiples. It is different for everyone. It's in a range, but it's just for your purposes of getting licking your finger, putting it in the air perspective. We do know what these numbers are. Okay, the multiple's 3. 3 times 12, everyone that remembers the tables, 36. Your business valuation is about $360,000. You'd then adjust that. You might see that there's some excess value, some excess assets that you're not using in your business that will affect it. But as a very, very broad brush approach, that is a good place to start. And actually, we picked 3 for a reason. 2.5 to 4 is a very, very common range of values for sort of up to $1 million turnover businesses in Australia. So it is different for every valuation report that I do, but you do tend to see a lot of convergence. You do see a lot around that part. I know I said I wouldn't answer questions as I go. Stacey's asked me, where do you find the multiples on your business type? Let's start with Googling it. That's a pretty good start. There's typically these packages of multiples are behind paywalls, but they'll often treat you with a few key metrics that you can find. There's a few reputable people out there in the market, pardon me. Anyway, this is a key slide. When you guys get sent these slides, or when you're watching this back on YouTube, pause on this one. Come back to this slide. It's going to help you. All right, so I've just told you can do it all yourself. Now I'm going to beg for your work. How ironic. Look, you can do it yourself. And if you're in the early stages, you should. You should not be hiring someone else to do things that you can do yourself. It is actually a great exercise in understanding things yourself to do a little bit of that heavy lift early days. You can do them pretty quickly. If you've got a Xero file out there, you're keeping it up to date, you can run your profit and loss. You can run it for a few years. Have a think about it. How would you normalize it? Come to a number. You can scribble it on a spreadsheet or a piece of paper, get your calculator out, do it on your phone. You'll get an okay result. It's going to be helpful for you. It's certainly more helpful than not. It's a great idea when you're testing the waters. Why would you come to a professional like me to do it? There's a few reasons. One of them is if the transaction is tax driven. So when you're selling a business to your own related party entities, the ATO says, well, I'm not going to trust any value that you put on this business because it might be a tax driven sort of contrivance. Typical one is mum and dad own Mum and Dad PCY Limited, a trading business. They want to put that business into Mum and Dad discretionary trust and for all of the different legal and tax obligations and improvements that come from that. Oh, okay. The business is worth $1, so I'm going to transfer the business in. No capital gain. Fantastic. I've done well. The ATO will turn around and say, you're selling to yourself effectively. We require you to do an independent valuation, or we don't believe your valuation. So instead, Mum and Dad come to me, and I do a business valuation report that says, well, actually, look, the business is worth $100,000. And then we investigate, small business capital gains tax concessions and exemptions to bring that down. But that's a good starting point. And again, it's an art, not a science. So we'll certainly pay attention to those factors that might keep that value as low as possible. So it is required for those sort of formal purposes. Often if you're dealing, again, with someone that's friendly to you, it's useful to have someone else to blame the valuation on. It's there's a professional telling us this, and that's a nice way to do it. The reason, You might not trust yourself. That's fine. We know not everyone's an accountant. Thank God you guys keep me in work. Some people don't want to be bothered with these. They're too busy building. That's fine. Come to me. Take it off your plate. I'm very, very happy to help. Particularly at the point where you're at the dicey end, you're approaching a transaction, you're approaching a potentially a life-changing exit that's going to impact your retirement. Definitely good to come through a professional. These processes, they don't exist in an isolation. You don't have to be following one of the 5 reasons before. You could be doing this for just to build a more valuable business now. You might not be even considering selling your business, but doing this valuation is a useful exercise. You can identify those problems in your business. You can identify, I mean, for a start, it forces you to really do a deep drive in your P&L. When you're zoomed in on running your business on day to day, you often don't take the time to step back and look at, well, how profitable am I? What is the value I'm bringing here? Where can I make things better? It's a really good opportunity to do that. It's a good opportunity for a business valuer, if you wanted to go professional, to actually say, well, if you tweaked a few things here and there, your business could quite conceivably double in value. It's worth bearing in mind. Even if you don't want to sell now, you might be thinking about, well, I'd still like to have a valuable business. You might just be thinking, I'd like to increase the wage I pull or the dividends I pull. Fantastic. That's a great reason. Um, Also, it demonstrates the things that are already firing. You might get a positive surprise. You might actually see things in this exercise that show, wow, we do really have a loyal customer base. We do have really good retention rates and low churn. Fantastic. Let's not lose sight of that. Let's keep on that path, because if we don't, suddenly a lot of the business value falls out the window. It also, look, it does allow you to set goals. It allows you to establish a benchmark valuation. Hey, let's do this exercise again in a year and see where we fit, see where we end up. Let's use that to track our performance. Your final takeaways here before we jump into Joel having a little chat and then answering your questions. The summary methods here, there are 3 of them. Take the nod, take the hint. Income-based is probably going to be right for you. It's right for most businesses, particularly small businesses. Um, it, it, the data should be there for your business. If you're the sort of business that isn't currently profitable or you don't have data, that's when you'd look to other approaches. But the income approach is going to be useful. The capitalization of maintainable future earnings is the technical term for it. It's called a number of things, but that's what I like to call it. That is going to be the straightforward method that works for most people. And again, it's reasonably straightforward. Look at your profit and loss historically, last few years. You might weight the last year more heavily. You might say that's a bigger contributor. It's typical. Normalize it, make it feel like what it would feel for someone else buying into the business, not for you. Multiply it by 3. You're going to get pretty close for most businesses. Someone's thrown up there in the chat, Nash Advisory. Yeah, Nash Advisories share those some really good free marketing content that has some basic borderline valuation multiples. Use them for that, and have a look at your value. It's a worthwhile exercise. Final takeaway for me, it's always just keep your records clean. I know I'm a broken record. Keep your records. Use experts when you need them, not before and not after. So we do have a value, I promise. I'm not just trying to gouge you, but you don't need us day one. You do it yourself first, have a crack, and then come to an expert. And don't put it in a bottom drawer. Use it. Use the good work that you've done to help you build your business, regardless of if you're selling it now or even just might be selling it in the future. Joel, if you're there, mate, I might hand back to you.
Thank you so much, Tim. Uh, really appreciate you walking us through what is genuinely one of the most misunderstood topics for small business owners this day. Now, before I jump into a little bit about how Lawpath can help, I just wanted to pose one last question, and I don't expect anyone to put anything within the chat, but if you want to, go for it. If someone offered to buy your business tomorrow, what's the number that would make you say yes? And more importantly, how confident are you that it is accurate? So yeah, again, feel free to chuck something in there. We won't hold you to it, but it's always fascinating to see what people think their business is worth versus what the data says. Now, just a quick recap on what we learned today. A business valuation isn't just for when you sell, it's how you measure the health and potential of your business. There's no one size fits all method. Different industries use different valuation methods. The key drivers of valuation aren't just profit, it's your systems, customers, brand reputation, and compliance strength. And most importantly, small mistakes in financials, contracts, or structure can drag your valuation down by thousands. And here's the reality: if you don't know your worth, you're probably undervaluating it, and that can cost you real money when investors, buyers, or even banks start looking. So, we recently worked with a marketing agency owner who thought her business was worth around 150K. After a valuation review with our accounting team, we found her contracts were standardized, her client data was incomplete, and she hadn't documented her systems, meaning a buyer would see it as founder dependent. And after 6 weeks of tightening her contracts, cleaning up her records, and restructuring operations, her updated valuation came back as 380K. That's more than double just by having the right legal and accounting foundations in place. That's the difference between guessing your worth and proving it. Now, this is where our plans can help you. If you've joined today thinking, I'd love to know what my business is really worth and how to increase it, this is exactly where Lawpath comes in. We've built flexible legal and accounting plans that help you protect, value, and grow your business all year round. So we have four main tenets of our plans. The first one is our essentials and legal plans. Well, I'd say three. I'll tie these two together. With the essentials plan, you get unlimited access to over 550 legal documents and accounting documents, I should say, as well, plus a lawyer who can essentially be on call throughout the year whenever you need it. So our plans are subscription based. So you've got 12 months, unlimited 30-minute calls with the lawyer, and they can essentially assist you with your contracts, your structures, and all your IP. We also dabble in, employment, commercial, HR related issues. If you've just created a company from a sole trader, you'll need your shareholder, director agreements. We've got everything from wills, Div 7As, everything you'll likely need. So on this call, you will get that support. You can choose a friendly lawyer from our team and have them as your lawyer ongoing, or if it's a bit busy, you can just choose someone else. And the wonderful thing about our team is that they're all on the same level of education, but one lawyer might be a little bit better with trust. One lawyer might be a little bit better with helping you structure your business in a certain way. So you can have one ongoing lawyer and then choose to jump around for a couple of days or a couple of weeks and speak to someone else. Wonderful network of lawyers who on our team who can assist you with everything for your business's growth. Next to that, we have the accounting advice plan, which almost works identical to the legal advice. You sign up and you get unlimited access for 12 months, unlimited 30-minute calls when that availability is there, to speak to someone who can obviously review your financial performance and profit margins, understand what's driving your valuation, prepare your books for investors or buyers, and identify ways to increase your value before you sell. All of this is covered on our calls, whether you have something super important to talk about, whether you want them to review your BAS, how you're reporting it, your zero, jumping on zero and getting help in setting that up, or if you just want to have general chats around where your business is going, and we can offer you, tax strategies and other things to help push you in that right direction. And when can I invest? How can I do it? Will I have enough money? We can guide you and assist you with all that. And then finally, we have our tax plan. So on the tax plan, we take care of your full tax picture, your BAS, your end of financial year lodgements, your reporting, and profit analysis. So your valuation is backed by clean, compliant financials. The accounting and tax are brother and sister. They are very much conducive with each other. They work perfectly. You go to the accountant, then when it comes time to do BAS and tax, it's the cherry on top. If you are considering one, for example, I would certainly advise to consider both. It's just the right and left hemisphere of the brain in full swing. You can bundle both or bundle all of it together And with our bundling system on our products and pricing page, you can put as many plans together, and we put a 40% off discount on top of that. So automatically you have a discount involved there. And then anyone who is attending today's webinar is entitled to a 20% off discount on standalone plans like our legal and accounting. So our legal is usually $1,668 annual, and I can reduce that down to $1,300 for you. Or if you are still new and you know you need these plans, but cash flow is a bit of an issue, we can get you on our quarterly option, which is usually 568, and we can reduce that down to 429. A little bit more expensive than the annual, but it's a bit more cost effective for those who know they need this assistance, but just don't necessarily have the cash flow to throw out $1,000 or so at that time. Practical next steps, guys. We don't want you to leave empty-handed. So after today's session, we will again send you a full record of today's YouTube link, as well as the slides, a little business valuation checklist on the slides, as well as some partner offers and more information on our discounts that I just threw in there. So that should be everything from me. If anyone is interested in getting an in-depth conversation going with me afterwards. It doesn't necessarily have to be right after. We all probably have our lunch breaks to run to. But if you are interested in knowing a little bit more about our plans and how we can help, please go ahead and throw yes into the chat. I want to make sure that I can contact you and have a quick, brief conversation about what you've got going on. If we can determine that there's nothing we can really do to assist you at this point in time, that's totally fine. Please keep going back to the webinars. Otherwise, if I can help identify any kind of gaps in your legal or accounting, I will obviously mention our plans again and give you some greater insight into that. That should be everything from me. I will throw you back over to Tim. Tim, I've gone and prioritized the questions so you don't have to go through the chat. So if you're happy for me to just read these out to you and you wanted to address those. Perfect. So let's go ahead and look at the first question. So Catherine Church said, if it feels like you're experiencing a downturn, do you wait it out before listing for sale, or just list it and hope assessment takes medium value over the last few years?
What a great question. The valuation will definitely take into account prior years as well. You don't just look at the last year. I would personally, look, I wouldn't wait to list it because it does take so long, but I would try and time it that at least you're in an upswing. You can be early in an upswing, but if you can demonstrate that, okay, the last year was bad, that's water under the bridge. But if you can show that you've turned the tide, that is a really good time to lock in a value. The other side will be doing that same exercise. And again, it's not, keep saying, an art, not a science. The story, if you can demonstrate it that it's backed by your financials, will be this is a business on the upswing and potentially will hit those same heights that were at years ago. Great question.
Thank you, Catherine. Amanda has asked, oh, sorry, that was a different one there. Amanda mentioned earlier that she's about to go into a big meeting with some investors, so I just offered our assistance. If you wanted to mention anything in relation to how we can help people, I guess, prepare for investments and communication with investors, Tim, that would be great. Otherwise, I'll just communicate with her outside.
Yeah, just go fully armed into that conversation. So at bare minimum, do this exercise yourself. If you're struggling, reach out for help because they certainly will be doing it themselves. Look, if you're at the early stage and you haven't entered into, the deal room, the data room, they might not know enough about your business yet. So this is an opportunity to get a bit of power in this negotiation. It's actually a great time for you to go in knowing your value before they get to see your books. So I think it's a great time to have a crack at it. Don't be intimidated. You're obviously, if investors are coming in and they're interested, they won't be the last. Don't feel like you need to rush or take an offer on the table. I would say any time from being involved in these conversations, anytime someone's trying to rush a purchase through, it's because they've got a bargain on their hands and they want to close quickly. There's nothing to stop you just from saying, obviously got to go through the process and appoint my own advisors. So it's exciting times. Good luck and let us know if we can help.
Excellent. Thank you so much, Amanda. Jordan Edwards has asked, what if you were doing profit rollovers to grow faster and making it seem the company is making less than it actually is?
Again, that process of normalization, if you're deliberately keeping your reinvesting profits, and that will all come out. It's not going to affect your valuation because it's something that we look at and we consider. So yeah, that's not going to affect your valuation. I'd say the proof will be in the pudding. If you've been reinvesting profits and it's putting your revenue top line up, that's going to be helpful for your valuation. But it's definitely something I would mention to a valuer if you engaged one to say, hey, this is why the profit margins are tight because we've been focused on growth. Potentially that will tip things in favor of using a revenue-based multiple rather than a profit-based multiple. So it is worth considering.
Thank you, Jordan. Alistair has asked opinion on EBITDA as the basis for multiples. And for those who don't know, it's earnings before interest, taxes, and depreciations.
Yeah,
Oh,
that's
yep.
the most common approach is to use an EBITDA multiple. It's solid. People use it because it works. It's not the only one, but it's the most common, most reliable method.
Thank you. Thank you, Alistair. Uh, Claudia has asked, what are Lawpath services on selling a business? Just due diligence report or full sale broker services?
So we don't do business broking here. We do what we're good at. We're very much focused on referring work out that doesn't suit us and really focusing on what we're best at. From my side of things, we do full tax due diligence and reviews, things like that, and certainly valuation reports. And we'd always recommend you use our lawyers as well. They're very, very experienced in buying and selling businesses of all types, even down to more specialized work like franchise work. So I would certainly recommend you do that. In terms of the broker service, there are plenty of brokers out there that can buy and sell businesses. They're not usually full service in that they don't normally do tax and legal. So you do you pick and mix from a few different professionals on that front.
Thank you, Claudia. Carmen has asked, staff retention rates also a good indicator of a quality business?
Absolutely. Doesn't affect your revenue bottom line. So that, or sorry, pardon me, your profit or your normalized EBITDA. But what it does do is that influences the multiplier. So the multiplier isn't set in stone. Again, art, not a science. It's a range of multiples, and you would say as a valuer, having observed the payroll records, all of the business records, we've got key staff here that have been in the business for 10 years. Our retention rates are high. That would tempt me to use a higher multiple because I would recognize the value there. So yes, I completely agree.
Perfect. Thank you, Carmen. Thank you, Tim. Obi has asked, if one is looking at selling franchises in the business, how would valuation impact this? And how does one determine an appropriate franchise pricing?
Yeah, that's an interesting one because in this regard, you're not actually valuing a business, you're actually valuing your brand. So that's one of those examples where you wouldn't use an income-based approach. If you as the franchisor, if you're looking to sell your brand to other businesses, you would be looking at valuing your brand, and the franchise fee that you would charge is going to be a percentage of that brand value. Now, there are very sophisticated ways of measuring brands that are for franchises. When you're starting out, if you haven't franchised before, you sort of take it with a grain of salt. But more developed, sophisticated franchises know very well what their brand is worth, and that is based on things like how often are they in the media. For the established businesses, are they profitable? Things like that. So yeah, franchise operations are a specialist arm of valuation. It's certainly something that we can support with, and again mentioned, Jess, one of our lawyers, is probably one of the preeminent franchise lawyers in Australia, so she gets it too.
Perfect. Thank you, Obi. Demir has asked, I'm not sure if the question you just answered might be in the same domain, but Demir has asked, how do you value websites' domain names and their Google rankings?
Yeah, again, you typically put them on the market. You might auction them. An auction is the best way of seeing what's out there in terms of value, because there is a reasonably liquid market. So there are lots of buyers and sellers for domain names. It's very low barriers to entry to sell those things. I would actually be a market-based approach here and looking at similar domain names, taking a similar word in a similar industry is a good way to start. Websites, yeah, probably there's not generally much website value if you're talking a static CSS, HTML website. It's typically worth its domain name and maybe what you've spent on it, all the way up to obviously more sophisticated, almost web-based app websites that are much more valuable. So yeah, it can be done, but it's one of those occasions where a market-based approach and looking for what similar domain names have gone for recently is going to lead you down the right path.
Perfect. Thank you, Demir. Phil has asked 7-year MPV is only 234K at 10% discount rate using constant numbers. How do you estimate the growth in EBITDA?
I didn't hear all of the numbers there, so and I'm not going to get my calculator out.
That's okay.
No, so I
I'll
found I found the question here.
oh, perfect.
So this is actually using the forward-looking the discounted cash flow methodology, which, as I've said, is not usually that reliable. How do you estimate growth in EBITDA? You again, how I don't know. How do you come to a reliable estimate of your growth of your potential business? It's to me, it's one of those things that is very difficult, and I think you would estimate that growth as a seller a lot differently to how a buyer would. Again, you can look at your previous growth. You can say, well, if your EBITDA growth has been 10% for the last 3 years, there's a fair chance it'll be 10% next year. But you do often see some very silly valuations put out that say, well, we've got no history, we've just started, but I estimate that we'll have EBITDA growth of 150% per year. You see a lot of these startups, in bubble times are silly in terms of those valuation estimates. Back
We've
to you,
got a
Joel.
couple more questions
Yeah, I've just
in
seen them coming through.
in we've got a couple more questions in the chat, but I might just ask if we can jump over to the Q&A real quick because some people have kindly put theirs in there. Scott Norman has a solid question if you wanted to take a crack at that one.
Yeah, can do that. So Scott is asking, do businesses with a secure revenue like government funding, such as NDIS or maybe childcare subsidies, do they present with a higher multiple? Yes, they do. Security of revenue is important. Just bear in mind, depending on the political fluctuations at a time, imagine if we had a strong opposition today, a strong Liberal National Coalition that said we're going to we're going to axe the NDIS tomorrow, so the day we get elected. In that scenario, my multiple might come right down. So it will certainly impact your multiple. It might not be the way that you think. Typically, those businesses should have a reliable but low profit margin. That's certainly the design of those sort of government schemes. Um, it is certainly an area where there's lots of activity in business sales and purchases. So it is there are observable multiples, and the numbers are usually pretty clean because typically you have to report through government processes. So that's how I'd answer that one. Yes, secure revenue is great, government revenue is great, but just bear in mind it can be affected by those political considerations. Scott's also asked, if you're a business owner taking a salary and involved in the business, um, do you take your salary out of expenses and put it into basically future dividends? No, don't do anything that you wouldn't otherwise do commercially, because either way, we'll factor it into the valuation. So when we do normalization, whether you pay yourself or don't, we'll pretend that you do. So if you're not paying yourself for a reason, don't start today. Ultimately, it'll come out in the wash. So we'll remove it from the valuation or put it back into the valuation, I should say, regardless. And then I might move on to the other questions as well. So Najib asks, talking about a consultancy and advisory service, accounting firms. He said he's got a bit of a split business where 70% of fees are from consulting and 30% are from digital white labeling. And Najib has asked, is that sort of business on a revenue basis? I might say that 70% of your value is on a revenue basis, and maybe 30% is not. Maybe particularly if that 30% is on a very different margin, I would actually do a split valuation. So that there's nothing to, you don't have to just use one approach. You can use a melded approach or a hybrid approach. Najib, I think your business, I'd typically start going down the path of a hybrid approach. and measuring your consultancy fee revenue separately to your digital sort of SaaS business separately. Um, Stephen's asked, do you need to consider what you'll walk away with before tax? Yes, the high level, the EBITDA multiple is important, and I think what Stephen's alluding to there is if you've borrowed money personally in the business to fund the business, when you're considering your value, you do of course have to factor in the debt that you have to pay out. And I think Carmen just has a question on pricing, Joel, that I'll let you reach out to her with. Other than that, I think we'll go back to the Q&A. Joel, do you want to read through the Q&A, or should I go back and see where we're up to?
Yeah. We had the next person was Stacey Gunn. How much is the average valuation for a small business?
$4,000. You're expecting a range or an iffy question there, wouldn't you? No, I know I do a lot of these. The average is about $4,000.
Lovely. Thank you, Stacey. Uh, Carmen has asked once again, do you have a ballpark cost for a professional valuation of an, oh, there we go,
Oh, sorry.
$4,000?
I've answered that question first. Yeah, $4,000. Where I've told poor Stacey that the average small business is worth $4,000. No, pardon me. The valuation report will be $4,000. No, there is no average. To go back to Stacey's, there is no average valuation for a small business. I would say there is an average um, profit multiple, and I think three. Well, there's a reason we used it in the slides. Three times your normalized profit is probably the average for a small business. So it'll very much determined by your profit.
Beautiful. Two more. Second last is Alex has asked, how does equity come into this equation?
Yeah, so I think we might be talking about enterprise value versus equity value, which is a bit of a nerdy sort of endeavor. Equity doesn't come into this consideration because we're valuing really a business here. So a business is very much looking at what's the actual value of the continuing business. Um, I think what he's alluding to is that some companies will have perhaps multiple businesses, but perhaps also will contain things like what we call surplus working capital. So there might be some cash stores, there might be some investments that they've made and other things within that company. So certainly we value a business based on a profit multiple typically, but then to find this equity value of how much the shares in the company are worth, we would then add the value of those assets on top of the value of the business. So I hope that helps, Alex.
Thank you, Alex. And we just have one last question from Mr. Deepak Singh. D, I had a lovely conversation with him yesterday. He asked, do we need a subscription to use your services, or could we use your valuation services as a one-off? Asking for myself and friends, clients I may come across. And he also mentioned, I have a share in a startup, which is values at 6 million 2 years ago, which was an arbitrary value, I think. How would you value it today? Considering the financials are not great, but have good brand value as a standalone brand in its niche. It's not a franchise.
Yeah, too easy. So absolutely, you don't need to be using a Lawpath subscription to use our valuation services. We're completely agnostic on that. Obviously, if you do have our subscription services, we know that your accounts are in good nick, and so that we have a stronger base position. We probably have a slightly lower price offering, but we're very happy to take work from that's been done elsewhere and use that to build a valuation. Very happy to service everyone, not just on a subscription basis. In terms of that valuation of the startup, I think I've already alluded to it. I've worked in sort of startups for a number of years, and some of the numbers you see thrown around are ridiculous, and they are, like you've said, Deepak, purely arbitrary. So that you might have been told it was worth $6 million back then. It's probably pre-revenue, it's probably startup. They've probably just valued the idea at $500 million and said that your share is $6 million. If you've seen enough of these pitch deck presentations where they say that they're companies worth 50 million on the basis that the accessible market is 6 billion people across the world could use my product, you know that those valuations are not worth the name. How would I value it today? Look, I'd say 2 years. Maybe if it's still running, it's still got runway. How would I value it? Still probably value it at close to nothing and hope that I'm wrong. That's the reality is most of those businesses exit with a nil value. And of course, for those of you that invested in Facebook early, you'll call me an idiot, and you'd be right in that regard. You just can't pick it. There's no formal way, particularly for you if you don't have access to those financials. Although you said you've seen their financials, you're buying into a dream, and I hope the dream comes off. But it's very, very difficult to really establish any sort of range of values on that. I'd say if they valued it at 6 million 2 years ago, telling you that the company was going to be worth a fortune within 12 months, and then they told you the same thing 12 months later, and now they're telling it to you now, take it with a heavy grain of salt.
Fantastic. I dare say that's everything. So, ladies and gentlemen, thank you so much for participating. Tim, as always, thank you so much for your wisdom and your guidance. Um, just a quick reminder, everyone, I will send an email with the slides and everything else that we've discussed today, as well as the discount that you can see on the platform, partner offers, as well as a YouTube link. If anyone is interested in having a chat with me afterwards and you didn't put your name down, but now you've changed your mind, by all means, go ahead and throw it into the chat, say yes or whatever it is you prefer, and I will endeavor to reach out to you today. And over the next couple of days, Monday, Tuesday, Wednesday, I will likely be reaching out to everyone just to pick their brain about what they thought of the webinar. So if you get a random call and you hear it's Joel from Lawpath, don't freak out. Just it's me. Yes, thank you all for your patience as well with the issue we had with the tech yesterday. Thank you for changing your schedules around. We hope it didn't influence your day for the worst today in any way. And we would love to have you again next time. Thank you so much for your time.
Thank you, Joel, but more importantly, thanks to everyone else. Really enjoyed that today. Great questions coming through, and I'm glad to see in the chat that people got some value out of it. So go away, clear up your books, do your self-valuation, and then come to me if you want another chat. See you,
Appreciate
everyone.
it, Tim. Thanks,
Thanks.
everyone. Have a good weekend.